Seth Klarman is a great value investor. He's very different than Buffett, though. His goal is not to buy great companies and hold them forever. He gets in and out of investments, and his track record is phenomenal. I think I read it's 20% a year going back 30 years. In the early 90s, he wrote a book called Margin of Safety. He only did a print of 5,000 units and now become kind of a value investing like Bible, kind of let me see if I have one. I actually have a copy. And I hope I still have it because it might have been lost in a move, but we will find out soon enough. So we're going to watch this 2.5-minute clip. Please watch the entire thing, and then I will comment afterwards. So here we go. What to do when stocks go down.
Appreciates a bargain, but when the market's going down, most people overreact and get scared. My stock is going down. What am I going to do? So if you're buying a sweater and it goes on sale from $400 to $150, you get excited when you get to the store. But if you have a stock or you bought the sweater at $400, maybe you're not so happy. So I think for me, it's natural, but for a lot of people, it's fighting human nature. But it is true, it's what Warren Buffett said. When you find out about it, it's like being let in on this little secret. And so if you can remember that stocks aren't pieces of paper that gyrate all the time, that stocks are fractional interest in businesses, it all makes sense. It's almost like you have to slow the game down, like they talk about baseball speeding up on you. Yeah. You need to slow it down. I can buy this thing for a huge fraction of what it's worth. What am I worried about if it goes down a little bit more?
So what's the gift here, knowing what it's worth?
I think that the analysis is actually the easy part. When I speak to business school students, I tell them investing is the intersection of economics and psychology. The economics, the valuation of a business is not that hard. The psychology, how much do you buy? Do you buy it at this price? Do you wait for a lower price? What do you do when it looks like the world might end? Those things are harder, and knowing whether you stand there, buy more, or something legitimately has gone wrong and you need to sell, those are harder things. And that you learn over with experience. You learn by having the right psychological makeup in the first place.
Well, stop. What's the right psychological makeup that you have?
So
patience would be one.
Willing
to sit on cash would be another.
Value investors have to be patient and disciplined. But what I really think is you need not to be greedy. If you're greedy and you leverage, you blow up. Almost every financial blow up is because of leverage. Yeah. And then you need to balance arrogance and humility. And I'll explain what I mean. When you buy anything, it's an arrogant act. You're saying the markets are gyrating and somebody wants to sell this to me and I know more than everybody else, so I'm going to stand here and buy it. I'm going to pay 1/8 more than the next guy wants to pay and buy it. That's arrogant. And you need the humility to say, but I might be wrong. And you have to do that on everything.
But are you different than Warren in terms of how Warren has evolved and how you have evolved? Obviously, I think Charlie Munger had some influence on Warren in understanding to not just to look for the classic example, the cigarette butts, but to look at things that were reasonably priced with the belief that they.
All right, so it's amazing to me. I looked over at Tim as I was watching this video, smiling, because I don't watch videos. So Tim sends these to me literally as I'm watching them. And he talks about, you guys have seen me on the show, I'll talk all the time. Investing, the hard part is not the value of the company. The hard part is when you see it drop a lot. Are you okay staying with it? I will say this, when the market's dropping a lot, it's a lot easier to stay with companies because I look at it saying, okay, I own this company and it's down 40%, but the market's down 20, 25, 30%. Or the market's down 50% and the stock is down 30. It's much easier to say this is a market thing. The hard part is when a stock is going the opposite way of the market. The market's up or flat and your stock is down a lot. These are hard things to do. But he's 100% correct that economics and psychology meet, and that's investing. Warren Buffett and Munger, 90% of the things they say, I think, are just basically what Ben Graham said. And Ben Graham always talked about how you don't need a high IQ to do well in investing. In fact, it probably hurts you. I will say that Seth Klarman, they were about ready to ask the question. I think this is Charlie Rose, right? Is that who this is? They're asking the question. They started to buy more quality businesses, and I think they're going to get into and hold on for a long time. It seems like Seth, if you go look at his approach and his portfolio, he is not trying to hold on to great businesses for a long period of time. And it all depends on what you're doing for a living, right? I have more of the, let me buy awesome companies at a slightly discount, I'm okay with that as long as they can compound. It's not quite the Warren Buffett way, but I'm doing what works for me. They talk about leverage. Guys, in full disclosure, I'm going to have a little bit of leverage in my account, but the difference is I'm not going to use that leverage to buy more stocks where it can compound south. And I'm not using a lot of leverage. There's a company called Long-Term Capital Management. They were 40-1 levered. So for every dollar of equity, they had $40 in debt. For me, every dollar of equity I have 25 cents in debt. And it's just a way for me, but I also have multiple revenue streams. I do options. I'll have dividends. I have 8 or 9 businesses upstairs. I have all these things. I have real estate. The point of that is to say that everybody has their own style. Seth Klarman, Warren Buffett, Howard Marks, John Hussman, they all have different styles. I have a different style. But what works for me is X, Y, and Z. What works for Seth Klarman is X, Y, and Z. But we all say the same things. If you go watch my video, it's not because I went and looked at Seth Klarman and I took notes and said, okay, what's he saying? Let me just repeat this. It just, over time, things started to make sense. Because like I said, I disagree with Seth Klarman on margin, but I'm sure if I talked to Seth Klarman and said, hey, I'm borrowing 25% of my portfolio to go buy real estate that I put 30% down payment on, and it generates, he'd probably be like, okay, it's not bad, but if you can do without it, and I get his point. His point would probably be like, well, do you really need to do that, et cetera. But for me, it works because I understand the risks and I'm able to do other things that allow me to hedge those bets and spend the money to hedge. With Seth Klarman here, we're talking about generalities, but the main thing is, are you able to be patient? And even the word discipline and patient, being patient's one thing, but being less emotional is another thing. You can be patient all the time and still be emotional. And you can be completely unemotional and impatient. In stocks, it's about sitting there and saying, the market's telling me that the price of my investment is lower and worse. Is the business actually worse? Prime examples right now are Meta and Alibaba. And these are 2 major investments that have fallen a lot. And I bought them after a big fall, but they've fallen further from there. So the question I ask myself is, what has changed? If something has fundamentally changed in the business, that is something completely different than the only thing that's changed is people's view of the investment, view of the company. Because I look at it saying, if I were able to have bought Facebook or Baba in full 6 months ago at a much higher price, would I have known really, if I bought them in full, there was no more market price to tell me what it was worth, would I have felt I made a bad investment? Well, no, I said, hey, listen, I think those are companies that are going to grow over the next 10 years and I'm paying a reasonable price for them. So therefore, I'm going to get a good deal over the next 10 years. Well, that's no different than you buying your house. No different than you out there who might own your own business. Not every year is going to be great. And the great news is your business isn't on the stock market, so you're not going to think there's a certain value of it based on what other people's perception of your investment is. But if you believe that markets can go overvalued and you believe that markets can go undervalued, you have to believe the exact opposite. So if you believe that, I always find it funny that Cathie Wood says now that her stocks are all in deep value territory. But when stocks were soaring, she said value investing was dead, et cetera. I'm like, well, wait a second. You can say that value investing doesn't work and it doesn't understand disruption. But then when it's down, it's like, oh, okay, value does work because it's working on my companies now. I just feel like those are not 2 statements that reconcile each other. And that's what I like about value investors. Their statements reconcile themselves. What are their statements? Well, this stock at 100 is terrible. At 20, it makes a lot of sense. Okay, that makes sense. And if you buy at 20 and it goes to 300, it doesn't make sense anymore. Potentially, unless the fundamentals have gotten 15 times better. That's the point of all this. And that's why value investing works for me. Now, I'm a very emotional guy, guys. And ultimately, I bet you I'm the most emotional person in this office. But for some reason, when it comes to investing in money, I have a deep sense of, okay, it'll all be fine. Probably has a lot to do with my circumstance. I own a lot of businesses upstairs, and I've gone over time to sit there and say, I'm here to generate more revenue and profit. And over time, that means they'll be worth more money. And that's what Seth Klarman is saying here. That's what every value investor says here. So guys, I really encourage you, watch more of those videos. We do a lot more reactions. We did a Peter Lynch reaction recently. We like looking at these investors because you'll see a consistent thesis over long periods of time. Please subscribe to the channel because we do 2 or 3 videos a day. And during earnings seasons, we do 4 or 5 videos a day. Thank you very much for your time. As the market falls, one of the most common questions I get is, what stocks should I be buying as the market falls? Great question. We're going to get into it right now by looking at our process for how we buy stocks.